Mr. B, how are you doing this evening? A1, good evening. When it comes to PUAs, does it make a difference if you submit PUAs at the beginning of the policy versus closer to the anniversary date? Highest return on investment is the goal. Yes, it does make a difference. So, actually, let me caveat that. It makes a difference if it's a scheduled PUA or an unscheduled PUA. If not every carrier will allow unscheduled PUAs, but if you have scheduled PUAs and they're split up over time, some of them will come in, some of them will be paid, let's say it's monthly. Some of them will be paid near the beginning of the anniversary year, some of them will get paid at the end. What your insurance company does, if it's scheduled, they will credit all of those PUAs that are scheduled with the full dividend amount. If you have unscheduled PUAs, however, they don't know that those are coming in. So there's no way for them to credit you the full dividend amount at the beginning of your policy year. So the unscheduled paid up additions will not get the credit until they get in there. So those will be prorated from when you pay them up later on in the year. Make sense? So if the maximum return on ROI is wanted, try and get those paid up additions in the first 30 days. If you get them in the first 30 days, you should get your dividend for the whole year. Hope that helps, A1. A1 says, final thought, James. Again, how do you address hyperinflation objection? Client says, what will happen to my policy if hyperinflation happens? Good question. What would happen to your money no matter where it's at if hyperinflation happens? Your money loses value. Same thing will happen in a policy. That $1 million death benefit, if we get into hyperinflation, it's not really going to mean a whole lot. It's not going to mean a whole lot. $1 million bucks, it could be worth $1 million bucks could be worth $100 in a hyperinflation environment, right? In a year or 2 years, right? That's just the reality of the situation in hyperinflation. You're going to have that risk no matter where you keep your money. So if I was to encounter a hyperinflation environment and I keep a lot of money in my life insurance policy, what I would do, I would borrow all of that money out of the life insurance policy. And I would buy an asset immediately. I would buy a house, I would buy a car, I would buy toilet paper. I would buy things that people need. You take that money out, you buy things people need, and when you sell those things to the people that need them for the massively inflated currency, suddenly you can pay off that loan pretty easily. So that's what I would do in a hyperinflation environment. I don't see hyperinflation as an objection to not get one of these policies. Because one, it's highly unlikely to happen. But two, you're not in a better position having your money anywhere else. Because you can always borrow the money out of that policy and buy stuff with it. Stuff that grows in value along with that hyperinflation.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here. And we'll see you next time.
Now go maximize your cash flow.